Sup traders, welcome in, much love. Trav here. Man, what an amazing weekend I had, but it's time to get back to work. And I'm gonna get back to work by sharing some ideas and some thoughts with you. Yeah, I'm driving, so might not be the best audio, might not be the best video experience for you. But the topic I want to get into is basically about why I think low win rate trading is superior to high win rate trading, and what that means especially from a technical system standpoint and a risk management standpoint. So let me first say that it might exist. I've never seen someone with a high win rate and a high RR. When I say high RR, I mean and high frequency. But even then, I don't see people who win 70% of their trades and their wins are 4 times larger than their losses. It might exist. I personally haven't seen it. And even in studying market wizards, these guys who do 100% a year, 200% a year, 300% a year, they're not doing that. Occasionally they're high win rate traders. There are some examples. Mark Cook is an example. 70 is like 80% win rate, 80% win rate. His losses are twice as big as his wins. So 0.5R, 80% win rate. That can work because you take 10 trades and you're up 4 and you're down 2, you're plus 2. But most of the guys are lower win rates, less than 50%. The best guys like 50% and their win rate is greater than 2R. But a lot of them say, hey, you gotta find a way to make money with the 20% win rate. Supposedly Richard Dennis, and Richard Dennis is one of the giants in this industry, one of the godfathers, one of the guys who turned like $5,000 client account to 15 million, 50 million, 100 million, crazy results. Supposedly his win rate was 10%. I don't know if I believe that, but I think it's superior. So I think the low win rate strategy is superior. So I was just talking about this yesterday with the one trader that I really talked to. And the idea here is, okay, me personally, I'm trading off the daily chart. And when I'm entering a trade, it's because I think the price is gonna go up tomorrow. The next candle is gonna go up. So if the candle doesn't go up, even if I'm stopped out, I'm not gonna wait. I'm realizing a loss right there. So I'm taking unnecessary losses, although I'll say that causes my actual loss to be on average negative 0.7 of what I initially risk. So my losses are smaller. Now, and I like to put my capital into something that's moving. So on one hand, I'm always closing my losers. On the other hand, what I try to do is never close my winners. Eventually, I'm going to get stopped out on a retracement and stopped out. However, what's going to happen is, every once in a while, if you look at the daily chart and expand it over a year or years, typically a couple times a year, maybe more in both directions, but say a couple times a year per asset, price moves in the same direction 10 straight days, 7 straight days, 12 straight days, and doesn't come back and make a lower low in that period of time. And this could be moves to the upside and moves to the downside. It happens. So if you're always cutting your loss, but you're never stopping you're always adding as well. Because if it just keeps closing higher, those are just signals to keep adding, right? Every once in a while, there's going to be a tail event where you're going to make so much money. And I've had it this year. I closed a trade at plus 16R, plus 16 times my risk. And I've been trading this way for 2 months, 3 months. The back testing, I see there's times where trades can go for 50R, 80R. It's crazy. And it's rare, but if you only trail your stop and you never close in profit, sometimes it will happen. You're exposed to it. And those wins are so much bigger than the losses. They pay for so many losses. Now, in the meantime, you cannot risk very much in each trade, because if you're low win rate and you lose 6 or 7 out of every 10 trades, you could blow up if you risk too much. And you want to make sure you have some capital for the winner, which you don't know which one is going to be the big winner. So that is the low win rate strategy, where you pyramid in and you trail your stop. There's different variations of this for trend following. I like to trail them at the day, or the last trend day. You could trail them tighter depending on, or wider. Trend followers typically trail their stop significantly wider. There's different ways to do it depending on how you want to manage your capital, but the same idea is letting your winners run and cutting your losers short. It means you're going to have a lot of losses, but your winners are going to be very large. You might have 30% win rate, but 4 RR, and you can make a fortune doing that. Now, on the other hand, let's take a look at a common high win rate strategy that amateurs do, which is called Martingale, and some gamblers try to use this as well. Martingale, on the other hand, it tries to be a high win rate strategy and is okay with a low risk reward, but what it does is, as price moves against you, or you lose the first trade, as price moves against you, you double your position. And then if it moves against you again, you double your position again. And then if it moves against you again, you double your position again. And eventually, as long as you don't run out of margin, it's going to move back in your favor, and you're going to be able to realize it at a profit. That's the Martingale risk management system. And a lot of amateurs do this. They average down. And what's funny is it works most of the time. Most of the time it works. Most of the time it comes back. But there's 2 problems. The first problem is it might take a while to come back. In the meanwhile, your capital is tied up in losing positions. Whereas me personally, I'm going to rotate my capital to something that's winning and moving today. I don't want any dead capital, right? Or at least dead risk. I'm not using all my capital in every trade, but I want to have max risk most of the time on whatever looks the best in the various markets, which isn't huge risk. It might be a couple percent per account over multiple positions. But the problem with Martingale is one, you have dead capital, and the second one is the once in a blue moon, when price moves 10 days in the same direction, 12 days in the same direction, when the low win rate trend following strategy would have made his whole year, the high win rate Martingale strategy blows up. It blows up because you run out of margin, and even if you're trading without margin and you're just trading, say, stocks or something, that may never come back. But if you're with Martingale, since you cannot realize the loss to be profitable, you have to keep doubling. At some point, you're going to blow up eventually on the tails. So for the low win rate strategy, you lose most of the time, but these occasional tails, you make a fortune. The high win rate strategy, you win most of the time, but these occasional tails, you blow up. And that's a little bit of an exaggeration, but that's sort of how it goes. And you can manage your risk better on a low win rate strategy. You can never advance your stop. You can have a system where you just take a real quick profit in advance right away and have really small winners. And you have a really low R multiple, but your losses aren't particularly big, right? You risk 1% and you win 0.3, but you never lose more than 1. That'd be one way to do it, but it's still the same thing in my opinion. I mean, it's definitely possible, but it's much harder. It's much harder. Now, I'm not saying to take bad trades. Like, I'm not okay with just taking bad trades and saying, well, I'm a low win rate trader. What I'm saying is how you manage your add-ons is the main, and stop loss is the main thing. With a low win rate, you can not have a stop and wait for it to come back. High win rate, you close out your loss quickly. Sorry, low win rate, close out your your loss quickly. With a low win rate system, you want to keep adding and adding to winners. With a high win rate, you add to losers. So it's not about the initial entry. The initial entry can be the same, and then you tweak the parameters of your system depending on if you're, I mean, the last thing is psychological. Are you okay with losing most of the time? You know what I found out though is with the high win rate systems, even though you're realizing losses, you can have the experience of winning most of the time. And the reason why is you keep putting on positions and then you're pruning the losers. So every day you're realizing losses, but you're having this huge equity run up because you have this huge open P&L. So it's like, I've had the experience of, in a week I'll lose almost every trade, but I make money every day, because every day I'm cutting these losing trades. I cut $1,000 here, loss here, I cut $1,000 there, but my core position that's working, it's up 2,000, it's up 4,000, it's up 5,000, right? So the funny thing about the low win rate is it's not as psychologically difficult as most people think. I think it can be psychologically easy because you actually can make money most of the time, and you never have to you do have to experience drawdowns at time, like balanced drawdowns, but you never have to experience huge equity drawdowns when you're in these giant trades and they're way underwater and you're hoping and praying. No, with the low win rate strategy, you cut that long ago and you're not stressed about that, right? So it's all about risk management, making the numbers work. And for me, yeah, like Stanley Druckenmiller says, and he learned from George Soros, it's all about capital preservation and home runs, right? Occasional huge trades. So this is what I find to be true, and yeah, that's where we're at. So let me know what you think. If you appreciate the free knowledge, comment down below. Heading home, a rainy day, but beautiful day. Okay, appreciate you. Much love. Peace.